get the show on the road here. I appreciate everybody's patience with all of this technical stuff, but that's what the exciting part about being something new and everything coming together like it is. So everybody that is on the call, this is where it's at. You couldn't be in a better place than it is right now with everything that we're putting together for you guys, where everybody's going to be able to make an incredible amount of money and able to save people a lot of money on their taxes. So a lot of people already know a lot about me, but to reiterate, my name is Gary Smith, and I am a part of Solar Equity Group. I have over 35 years of sales and management training, both with direct sales and motivation, and I've worked with a lot of people over the internet, helping people with websites and Excel, and be able to put scripts together, be able to train on every aspect of communication so people can say what they need to say. So, and I've trained a lot of you guys personally. You guys know that, and I appreciate each and every one of you. I'd like to also talk a little bit about Justin Kaiser and what got me connected with this company. Justin Kaiser came to me about, I think it was around late August in the business, and he approached me with this program. When I first heard it, it was actually, I'll be honest with you, a little over my head, but I could tell right away that he had something special about it, something that made me want to continue talking with him, and wanted me to know more about it. Even though I didn't understand a lot about taxes and what he was talking about, how we're able to save people money and where they're able to get money back on their taxes in the past, and how we have a vision with renewable energy. Well, it was enough for me to want to talk to him again. The more I talked to him, the more I was pulled in, to the point where this is what we came today. And he saw me as somebody that could help him in his vision and with my skills and my management skills. So we came to agreement, and we started working together, and I'll tell you what, it's been a blast ever since. We have the most unique opportunity I've ever seen, and let me tell you exactly why. We have a situation where we don't have to ask for anybody for any money. We are offering people a way that not only they can get money back on their taxes, not only are we expanding renewable energy, which is a good idea anyway, but let's face it, there's a lot of money that can be made here. Okay, people work a lot of hours and work real hard for just tiny bits of money. The chance and the opportunity, what we have right here, kind of like a closed door policy, is incredible. So anyway, I want to pass you back over to Justin, and let you take it over. But just pay attention, write everything down that sticks out, and and really take this opportunity seriously, because things like this do not come around every day. This is a once in a lifetime opportunity. So Justin, go ahead and take it away.
All right, Gary, thanks so much. That's
We're getting a lot of background noise there. I don't know.
For the company today, so thanks so much for that. Ladies and gentlemen, we have an extreme mission here and a vision, and that's to accelerate the world's transition from unsustainable fossil fuels to energy through practical economics. And we put together really the perfect combination here to advance solar technology and solar projects through, like I said, practical economics. And we'll get more into that here in just a little bit. We've got a couple of very special guests on the line today. First and foremost, we've got our IRS enrolled agent, James Harnsberger, who is, by definition, a tax expert. Now, the great thing about being a tax expert is he knows the tax law. He actually represents clients in court. He represents pro athletes, celebrities, very high net worth clients, as well as large corporations. And, he's just a very invaluable resource for us. So we're very thankful that he's on board with us and everything that he does with us and all the questions that he's able to ask for the potential clients that we have, and also the other tax professionals that we have that are on board with us. And we've also got another very special guest on the line with us. His name is Malcolm White. And Malcolm White is a CPA. Now, by having Malcolm White as a CPA, we've got the best of both worlds by having two extremely knowledgeable tax professionals on board to help us with everything that we're doing. Now, our mission is to fund clean energy through practical economics, and we do that through tax-based incentives. So I don't know if everybody is really aware of this, and really nobody's really talking about this, but we've got a major problem here in America. We've got an outdated and centralized power grid, which makes it very vulnerable to both natural disasters and terrorist attacks, which is really quite interesting, being that we're the world's most powerful country, first world, nation on the planet, and we've got this outdated energy grid. It's like, what are we doing here? I mean, we're way behind the rest of the planet when it comes to natural and green energy. Germany's at 78%, and we're at like 13. So we've got to do something about this, because the fossil fuels that we're using right now are inevitably going to run out in the next several generations. We need to do this to protect the planet for not only our future, but our children's future, our grandchildren's future, our great-grandchildren's future. And so that's really what this is all about. It's not just about saving money in taxes, which is absolutely the monetary benefit that our clients are going to get from this, but it's about advancing green energy across America. So what we actually do is provide, through tax depreciation, through tax equity, net operating loss and tax credits to our clients by them becoming a general partner in an actual solar energy company. So we provide this opportunity for clients to pay at least $100,000 a year in taxes, whether that's federal, state, or a combination of both. Any individual or business qualifies that's in that scenario. They go through the process. It's completely free for them. They don't pay any fees. So it's simply sign some paperwork and let our tax professionals or your tax professionals handle everything from there. And we've got our two main tax professionals on board with us to coach your tax professional through this process. So without any further ado, what I want to do is introduce one of our tax professionals and let him go over one of the questions that a lot of tax professionals have, which is, how in the world are we able to go back and amend and use NOL for 2 additional years into the current year? So with that question, I know we've got several CPAs on board and that are on this webinar that are listening to this, and some of you have that question. So we'd like to get that question answered. So Malcolm White, are you with us, sir? And can you help us answer that question?
Yes, I'm here, Justin. Thank you for having me on today. I appreciate being part of this panel today, and also appreciate being part of SEG, which is a phenomenal idea, a phenomenal organization. As I'm sitting here and listening to you, I'm thinking we are probably past peak oil at this point. And what a lot of people don't realize is that we take this incredibly valuable resource and burn it up. Billions and billions of gallons of it, on a practically daily basis. We burn it up. The thing is, once you start to understand petroleum, you realize that we get thousands of products off of petroleum, not just gasoline or diesel fuel. We get thousands of other products that we use in our daily lives. And we're taking a lot of this valuable resource and burning it up for a single use that could easily be replaced with solar energy and alternate fuels. So it's incredibly wasteful what we're doing, and we're going to deprive future generations of not just the fuel, but of all of the thousands of other products that we get off of petroleum. And we need to think about preserving and taking care of that as a long-term resource that we dole out with a great deal of wisdom. Not just burn it all up as fast as we can and think that something's going to come along and take the place of those thousands of other products that we get out of petroleum, that we're just kind of saying, oh yeah, well, we'll figure out a way to replace them when the time comes. Well, some of them may, not all of them. So this is a really important thing, what we're doing here, and I'm glad to be a part of it. So back to your question, what gives us the right to do operating with operating losses? Let's think about that in two terms. What if you have more losses in one tax year than you have profits? You're going to have a net operating loss for that tax year. That can be on a corporation, a partnership, an LLC, an individual. And what most people don't realize is that those NOLs, when they happen, may be more than you can absorb in one tax year. In other words, your losses might be more than your profits in any given tax year. So Section 172 of the tax code says if that happens, you can carry back any excess net operating losses to the prior 2 years and get an immediate refund. So that's Section 172 of the tax code, and it allows that for both individuals and corporations. So what we have here is a mechanism whereby we determine what amount of NOLs would you need to wipe out all of your taxes for 3 years, the most current 3 years. And then the LLC issues a K-1 with that amount of NOLs for the current year. So let's say that's 2015 is the year you're doing the tax return on. There's going to be more NOLs than you can absorb in 2015 on that tax return. So we're going to take the remainder and carry it back to 2013 and 2014 and wipe out those taxes. And the goal here is to have enough NOLs to wipe out all the tax, all the income tax in all 3 of those years for a taxpayer. And they will then get that back from the IRS as a refund. And in some cases, there will be some left over, and Section 172 goes on to say if you don't use it all up in those 3 years, you can carry it forward for the next 20 years and use it up when it becomes available, when you need it. So you can use it up in 2016, 2017, however long you have to go, you've got 20 years to use it up. So that's all covered in Section 172 of the IRS Code. The IRS spells out pretty well in their regulations how to do that. We use a fairly simple method. We amend the current year return, and the remaining NOLs go on a Form 1045. The IRS likes us to use the 1045, and they like us to put all of that together so that when they get the amended return, they're getting all 3 years, and they can assign that to one person and process it in one step. Otherwise, if you had that in 3 amended returns, that might go to 3 different desks. You'd have 3 different people processing those amended returns. And let's say the person doing the 2013 return, the 2015 hasn't posted yet on the system. They're not going to be able to do that job. So by consolidating all of that in a single filing, a 1040X, along with a 1045 with it, we're giving the IRS one package all at once, and they can immediately sit down and process that entire return very quickly and efficiently and get that refund coming back to the taxpayer. And that's efficient on their side, and that's why they have set up those specific procedures and processes to do exactly what we're doing here. So that's basically it in a nutshell. If I can answer any other questions, that's great. I'm here for a little bit.
Great. Thanks so much, Malcolm, for clearing all that up and explaining exactly how that works. And I know some of you may have, something coming to your mind right now. Well, wait a minute. Are you taking money from the government? Are you pulling money out of the IRS? And the answer is the IRS has already accounted for $22 billion. That's billion with a B. Tax equity, tax credits to allocate towards this. They've already allocated these, and not only that, they've already allocated net operating loss to the solar energy companies. So they've already accounted for these losses in some way, shape, or form, and all we do with Solar Equity Group is transfer who's going to use those tax benefits. And with our clients becoming a member in the actual Solar Energy Company LLC, they're able to use those solar tax benefits. So that's all we're doing here, everybody. And that funding is being put to very good use. It's going right back directly into solar. putting on people's rooftops and commercial buildings and so forth to advance an agenda that Congress has made to the American public that by the year 2030, 20% of America is going to be powered by clean energy. And like I mentioned, we're way behind right now, less than 13% or so being powered by clean energy. So even if we do hit 20% by 2030, we're still going to be 3 or 4 times behind the rest of the planet is today. So it's very interesting that as powerful of a country and a nation as we are, that we're so far behind when it comes to this. So that is our vision, that is our focus, is to first advance solar energy, get rid of old, dirty, outdated, dangerous, antiquated energy. And not only that, but we're vulnerable to terrorist attacks on our power grid. I mean, the way it's set up right now, it's so centralized that just 2 or 3 major attacks on our power grid could take out most of America's power supply, leaving us with a complete and total economic collapse. So this is a major problem. Somebody has got to step up and do something about this. And this ultimately is our vision with Solar Equity Group, is to decentralize the power grid, and everybody that comes along and participates with this is going to be greatly rewarded with tax benefits. So thank you again, Malcolm, for that very in-depth explanation and overview on what makes carrying back net operating loss available, why that's 100% legal, why what we're doing is ethical and everything. And with all that being said, I want to turn the call over to our other tax expert, which is James Harnsberger. He's an IRS enrolled agent. And like I mentioned before, by definition, that means he is a tax expert. Now, Malcolm is a tax expert as well, but a lot of CPAs aren't. And that's nothing bad against CPAs at all. It's just not what they're, a lot of them are really versed in. CPAs do a lot of other things, such as bookkeeping, they do P&Ls, they do wealth planning sometimes. They do a lot of other things that they specialize in, and a lot of times people get it mixed up that just because somebody's a CPA that they're a tax expert, and that can be further from the truth. So I want to introduce James Harnsberger. James is our very first tax expert that came on board with us, and he's been an invaluable person that has came on board and vetted this whole entire process out. He's done his research, hundreds of hours of research, going through case law. I mean, what he's done for Solar Equity Group is really incredible and invaluable. We're very appreciative that he's on board our team, and we're so looking forward to what the future holds with everything. James also owns a couple of other companies. He teaches people about wealth building and coaching and finances through his company, Wealth and Tax Guru. So I want to give a shout out right now to that. If anybody is looking for a wealth coach, please go to wealthandtaxguru.com, where you'll learn about what James has to offer you and teach you. It's really invaluable ideas and principles that are proven, and he's implemented these with thousands, tens of thousands of his members across the world. So without any further ado, James Harnsberger, are you there, sir?
I am, Justin. How are you?
I'm doing well, thanks. How about you this evening?
Very good.
Great, great. Now, James, just to kind of keep these webinars just a little bit unique, every one we do, one topic that I'd like for you to touch on today is kind of the risk involved with this. If somebody gets involved, I know that's kind of one of the major questions that people have, their CPAs have, is if somebody is going to get involved and become a general partner in an actual solar energy company, LLC, what is the risk? And one thing I want to say right now, one thing that mitigates the risk is the fact that all the solar energy company, LLC, it's a company that's set up to fund solar energy projects. It's actually separate from the installation company itself. So that mitigates a lot of the risk right there. But other than that, James, what really is the risk involved in here? And can you explain to everybody that's watching this why this really should be kind of a no-brainer to them to get started and help us advance our agenda of funding clean energy across America?
Well, I think just to set the table a little bit, I think where the confusion comes, and I give an analogy, you can ask a room of tax professionals a question, and let's say you have 100 tax professionals, and you're likely to get 300 answers. And that's not a reflection on the tax professionals, that's a reflection on the convoluted tax code that we have and the finite amount of specialization that requires people that are in the field of tax to really know the area of their expertise and what they're doing and how it all sort of works. The risk, risk is risk. It's really the LLC in terms of the structure and the way it's set up, because you have two entities, one that does the installation and one that does the equipment and the financing side of that. It's pretty straightforward. The agreement, the capital contribution agreement, the position that a person would have as a general partner reverts back to the LLC after 6 years. And that's an important trigger because the debt that the LLC might incur when they finance projects, the debt is structured so that it's a 25-year debt structure. And so even though you're a general partner, you're not a managing general partner, and you're not absorbing any risk for the recourse debt, because the term of the debt extends beyond the revision rights of the position that you would have as a general partner. With respect to the position of a general partner, this is where a lot of confusion amongst tax professionals can come about, and it's really pretty clear that in 2009 there were 3 cases that came out of, 2 of them came out of the United States Tax Court, and 1 came out of the U.S. Court of Claims after the 2 cases in the tax court were decided, and sort of formed this 3-legged stool about how a member of an LLC can be a general partner without having the passive activity loss limitation rules or the 500-hour limited participation rules apply. And basically, between the Gregg decision, the Garnett decision, and the Thompson decision, the courts have concluded back in 2009, and have pretty much settled this with the IRS attorneys, the Office of Chief Counsel issuing an AOD, action on decision, to acquiesce as to results of the decision, meaning that they're not going to litigate this issue, is that when you're a member of an LLC, remember that the LLC is a creature of the state by statute. And every state, under the 10th Amendment of the Constitution, reserves its rights for anything not enumerated in the federal Constitution. And a member of an LLC is not a partner for purposes of the application of 469. More importantly, the temporary regulations that have been on the books for 26 years that allude to or leave one to conclude that they might be limited partners subject to the passive activity loss rules, what they call PAL. On the face of reading that, one would probably conclude erroneously that, yes, if you're a member of that LLC, you would be subject to the passive activity loss, and then your losses would be passive, not ordinary, and that is not the case. The first case that really framed that was in Gregg, the Gregg decision, and the Gregg court basically put an end to the notion in the regulations that your participation in a limited liability company is anything other than a general partner. And when Garnett and Thompson were subsequently decided by those 2 courts, they also took it a little bit further on other issues that dealt with not only the issue of the general partner status, but the issue of maintaining the limited liability, because that is governed under the state statute, and every state basically has a uniform approach to formulating those statutes. What was interesting in the Thompson decision was that the IRS had argued both sides of the same coin, that this particular temporary regulation was out there, and that because it didn't enumerate any specificity as to the status, the IRS took the position that if you're a partner and you get a K-1 from an LLC, you are by default, under partnership rules, a limited partner. And the court clearly corrected the IRS's erroneous position and held that that is not applicable. In fact, rendered the entire matter moot as to the status. And what we're left with today is that if you are a partner in an LLC under the structure of this solar energy company, you will be a general partner for tax purposes, and therefore your losses would be deemed and treated as ordinary losses because 469 does not apply in any case. Then the question becomes one of the capital contribution versus the net operating loss. And so you have this difference between the actual amount of capital that you're contributing to the LLC, that's how they monetize the tax equity to fund the next project, and the amount of the NOL. So let's say that your capital contribution is $100,000, but your net operating loss is $300,000. So you have the difference between the NOL amount that you're looking at and the amount of the capital contribution that you're making, and that difference is reconciled in what is called your allocation of the recourse debt of the LLC. And so let's say that you have a refund of $100,000 and your capital contribution is $90,000 and you keep $10,000. Well, then the difference of the $300,000 and the $90,000 would have to be made up, and so your K-1 will reflect a number allocated to you based on your percentage of the ownership to that LLC for that recourse debt. And though it's recourse debt in the true sense of the contractual obligation of the LLC, it is rendered moot because the debt instrument is a 25-year debt instrument, and your position in the LLC reverts back to the LLC in 6 years, and so you would not have a risk of having that debt. Then the 10% that you keep in the refund would otherwise be treated as a capital gain, and so you make the adjustments between the NOL. This is an accounting where people like Malcolm are really valuable. You make an accounting adjustment so that you reconcile that difference and it's not treated as a capital gain. This is known as the basis rules because you cannot take, under the tax benefit doctrine, you cannot take a tax benefit greater than your basis in property, or your basis in stock, or your basis in capital contributions, etc. And so I think, to clear the fog and not to get too deeply technical and glaze everybody over like a jelly donut, it's real simple that if you're thinking that the passive activity loss limitation rules apply, or that the member is a limited partner, or that they have to meet the material participation 500-hour test, those have all been rendered moot by these 3 court decisions, and there is no position that the IRS is taking going forward that they're going to further litigate this. I mean, losing 3 in a row is probably enough for anybody at the end of the day. And so as my role in trying to help Solar Equity Group, working with Malcolm, who's been a pleasure to work with, is to provide technical guidance and technical support for the tax community, the tax professional community, to allow them to look at the memo that we've created, look at the court cases that we have researched, look at, you know, Section 172 that Malcolm mentioned, and I would also caution to read 172 Section B1, because that actually does talk about how to carry the loss back. And you can also find that in IRS Publication 563 if you are so inclined to read a lot of legalese. But anyway, the short of it is, with regard to the tax treatment, this is how it's supposed to be treated. And what we also do in helping Solar Equity Group is work with the accountants that are doing all of that for the solar company to make sure that we're vetting the information, that there's no inconsistencies, and that everything is following the GAAP rules and the compliance and reporting rules, and just make sure that everybody's following the rules the right way, so that everybody has a high confidence. And then if there are questions, somebody had asked, I think on the last call, what if I get audited? If you got audited, it probably wouldn't be for this issue. It probably has something to do with something else substantive on your return. We're not making any substantive change or material change to the information on the return on a carryback. You're just wiping out, and that's by exercise of the election to forego the carry forward. You're going to carry it back and use the 1045 form. And Malcolm makes a very good point. That's a package that gets submitted, so it gets processed in a uniform manner. It makes it very easy to do. And to your point, Justin, these have already been reported by the solar company, so they're already there in the IRS system, and transferring a tax equity or a loss is not a new concept. There are entire exchanges that are set up trading losses from LLCs. You can buy a person's loss in an LLC, making a capital restoration agreement, and take that loss on your tax return, and not have to be a material participant in that business. And there are entire exchanges that set up and trade these things. Corporations like Google buy these things by the billions of dollars to mitigate their tax exposure. And it's been Congress's intent to stimulate the economy to avoid bailouts. We learned about Solandra and some of those companies. That didn't work out so good with the shovel-ready I don't know what. And the taxpayers got stuck with that bill. And so Congress, in its infinite wisdom, decided, you know, this would be a great way to monetize the transferability of tax equity to third parties and not be in a position where taxpayers are going to be bailing out solar companies that were not fiscally sound. That's more of a political commentary, but, you know, the extent of the application of how it works, why it works this way, the legal authority, the research that we've done, and the memos that we've generated in doing our due diligence give us a high degree of comfort that if you follow the rules and you do it in this order and you do it in this way, you will be rewarded in terms of your own pecuniary interest, and you'll be helping the country get off of the the centralized grid system that we have, and doing your part in making America great again.
Thanks so much, James. Yeah, it really is a win-win-win situation. As James just explained, you know, this is approved by the government, and it's respected by the industry, and it's expected by the IRS. So, like I said, it's truly a win-win-win scenario. There are no fees involved whatsoever. It's simple paperwork, and then wait for them to come back, as well as, you know, your capital contributions as far as your estimated tax payments go. That's something that our tax, as well as your tax experts, will work out as well to figure out exactly what you qualify for and what you're going to do moving forward as capital contributions to the solar energy companies. So thanks again, and thanks again, Malcolm, for being on this webinar. We really appreciate you guys. Kind of doing tax experts here, main tax experts. So you guys are here. And thanks again, Gary, for what you do, our business development manager and our trainer for our ambassadors. And at this point in time, Gary, I'd like to ask if there's anything you'd like to add to this, and before we wrap it up.
Yeah, that was incredible, James. You just seem to make it easier and easier to understand all the time, even though a lot of it's over some people's head. I was just blown away. You really summed it up. So, no, I don't have any questions. James did a fantastic job. Everybody did. Thank you.
Thank you.
This is good. That does mean a well job done. So, Malcolm, is there anything you'd like to wrap this up?
I think James did a really good job of covering this. I think one of the things that might confuse some CPAs is how do we get to do some of the things. How do you have an entity like an LLC and treat it for tax purposes like a partnership, but you get to do a bunch of stuff that kind of looks like, you know, magic behind the scenes that doesn't quite look right. Well, an LLC is not a partnership. That's what it boils down to, and that's what James was pointing out by citing the court cases, where the courts have been very specific about saying it's an LLC granted the rights to be a type of entity under state law. And when these things started coming out, the IRS really didn't know how to deal with them. So they said you can file on a 1065 partnership return, or you can file on an 1120 corporate return. Take your pick. But you're still, for state purposes, you're still an LLC. So I think that confuses a lot of CPAs. They say, well, how do you do all the things you do with an LLC? Why don't you have to follow partnership law? Because a partnership is also covered under state law. So are corporations. There are three different types of entities. So you can't be confused with the legal side of an LLC. That's one issue. The tax side is another. We're simply saying this is an LLC for legal purposes that is filing a tax return on a Form 1065, which is a partnership return. And that's just a choice that the entity can make. And what goes along with that is that those pass-through opportunities, we could also do it on a 1120S and treat it like a S corp and get pass-through benefits. It just turns out that the benefits are easier to pass through from a legal standpoint, from a technical standpoint. It's easier to do it as a LLC, treat it as a partnership. Everything just lines up perfectly when we do it in that way, when we structure it in that way. So all we're doing is taking the best of all the worlds, putting them together in a single package, and offering it to taxpayers.
Excellent. Well, thanks so much, Malcolm. We really appreciate you being on here and taking the time out of your evening. I know that you and James both have things that you need to attend to tonight. So thank you again. And ladies and gentlemen, if you're listening to this right now and you've got some additional questions, we're going to need to wrap this up right now. But what we can do is we can actually schedule a call with either James or Malcolm and get your questions answered individually. But the PDF that James and Malcolm have prepared should answer about 90–95% of your questions. So if there are any additional questions after seeing that PDF, which will be provided to you from one of our ambassadors, then we'll be certainly happy to set up a private call with one of our tax experts to get those questions answered. So thanks again, everybody, for taking the time out of your evening. We're hoping that you're walking away with something very valuable here tonight. We're extremely excited with what we're doing and helping advance solar energy across America. It couldn't be the more perfect time. Solar energy is so much cheaper than what it used to be just 5 years ago, and so much more efficient. And most of the country is still unaware of how efficient and how affordable it really is. So while none of our clients actually have to have solar equipment on their own rooftops or on their businesses' rooftops, we have put something together here that you can benefit greatly from. So I'll leave everybody with that. I think everybody again, and we'll see you next time. Take care now.